Everybody.
Hi, Franz.
They don't. Happy Friday, guys.
Happy
Hey,
Friday.
where are you calling in from?
Charlotte.
Oh, you're right here. Okay. Yep.
Yes, sir.
Great.
All right.
Like I said, you guys could take yourselves on and off mute as you like. We'll be pausing for questions. We kind of want to make this as interactive as possible so you guys get your questions answered.
Yep.
And it's 2 minutes after, so I think we'll get started. We'll probably have a few more people joining us, but if you want to kick it off, Britton.
Yeah, absolutely. Thanks, Todd. Okay. Welcome, everybody. Yes, happy Friday indeed. We've been doing these sessions for a couple of years now, around every quarter. So this is the Wells Fargo financial calendar for employees, and we're going to be focusing on the mid-year review for you. And we've got the financial calendar for you. If you don't have it already, we'll provide it to you at the end. We've got some other information I'll talk about in a couple of slides that may be helpful that we can send to you. But the point of this is to provide you some actions to take to keep you on track. There's a lot of different movements financially throughout the year, whether it's tax related or investments. We want to make sure you're on track. We're going to touch on some important points that you can walk away from this presentation and do. But we want to hear from you. Look, you got questions. Everyone's situation is unique. If you feel like you want to ask in this space, by all means, you can type it in the chat throughout. We'll get to it, or we will be pausing every 10 minutes or so to hear from you. And then in the end, we'll have another Q&A. Our contact link will be in the chat. So if you ever along the next 30, 45 minutes want to schedule time with us, that's how you can do that or find more information about us. So my name is Britton Williams. I'm a financial advisor along with Todd Calamita. I'm a business partner at Calamita Wealth Management, and we're going to be taking you through the next 45 minutes of this material. I want to hand it over to Todd first to talk a little bit about life insurance policies.
Perfect. Well, yeah, thank you, Britton. And like I said, welcome everybody. First thing we're going to do is we get this question a lot. It's, how much life insurance do we need, right? So that's a big question. You're told different things. The first thing I'll say is we don't sell life insurance. So we really, we're unbiased. We just want to get you as much as you need, but not any more. So we actually try to kind of minimize the amount of insurance so that it's most cost effective for you. And the first question is, why do you need life insurance? The most common reason you need life insurance is to protect your spouse, and if you have kids, financially if you pass. So we don't believe it's for investing necessarily. Sometimes you'll see that. If there's other reasons you have life insurance, drop it in the chat. We want to hear kind of some of the other reasons that people have life insurance, but that's the main one: financially protect the spouse and your family. The next question we get, and there's a lot of confusion around this, is like, what kind of life insurance should I purchase? You probably hear a lot of different types out there. I'm going to take you through kind of three of probably the most common that we come across. The first one is term insurance. So I like to kind of make the comparison between that and car insurance. So you pay for a term and it's done. If you stop paying, you have no more insurance. So term insurance is just that. You might get a term policy for 10 years, 15 years, 20 years. Those are usually the most common we see. So it's for a set amount and it lasts you that period of time. If you stop paying the insurance, then the insurance is, it's gone and you don't have it. So that's term insurance. The next one, again, I'm going to keep these kind of high level. Next one's whole life. And this is more of a permanent insurance policy. So it's in essence for your entire life. The difference is the premiums will be much higher than a term policy. The main reason is you're combining sort of your insurance need with, I'll call it a savings account, for lack of a better word. But so you're building up what's called cash value, or you're earning interest on a portion of your premiums. We feel like it's usually not the most efficient to combine life insurance and savings. but that is a product out there. Again, the premiums tend to be pretty high. And it's usually not the most efficient, to combine that with your savings. The next policy out there is a variable life policy, and that combines permanent insurance sort of with investing. So instead of it being like a savings account that might earn 3 or 4%, you can invest it. And again, think of it as like in a 401k where you have investment products inside your 401k. It's the same thing within a variable life policy. Again, usually don't suggest it because it sort of dilutes the insurance, dilutes the investment, so it doesn't end up being the most optimal type of insurance, and in the way we view it. But if you do have insurance, be curious, just drop it in the chat there. If you have term, whole life, variable, we'll talk a little bit about the Wells Fargo provided coverage as well, and we'll talk about how much is too much, because again, we want to kind of get you enough to be covered, but not too much. The Wells Fargo provided coverage, as you may be aware, it's 1 times your salary up to $50,000. And then Wells Fargo also does give you the option to purchase more life insurance, which sometimes is not a bad idea, especially if let's say you have 500,000, you think, okay, maybe I need 100 or 200,000 more. It's not a bad way to do it. It's pretty easy. You just sign up for it during benefits time. But the downside to a group policy like Wells Fargo's and any other employer insurance policy is that if you leave, that insurance does not go with you. So if for some reason you come down with some type of terminal illness, then if you have to leave that company, you won't have access to that insurance anymore. So that's why it's good to have some kind of in your own name as opposed to just through an employer. So that's kind of a high level on insurance. I don't want to go too deep on that, but I do want to think of the next page, Britton. We do have a kind of a basic level of how to calculate how much you need. Yeah, so there you go. Yeah, so this is just a sample calculation just to give you an idea. You can kind of look at your own situation and map it onto here. So in this case, this is a working spouse, age 50, who has a mortgage balance of $400,000. I'm going to kind of take you through some of the items that you want to consider when calculating how much insurance you need. So in this case, this person has a $400,000 mortgage balance. They have a college education need of $200,000. And in this case, they've saved up about $100,000 in a 529 plan, so an education account. So their net need for college is going to be the 200 minus the 100, so 100. And then here's where it gets a little bit tricky. And I will say this is that what you need for insurance, kind of how much, it's a little bit of an art, a little bit of a science. So there's not an exact calculation. I'm trying to give you a bit of a framework of how to go about it. Typically when you get closer to retirement, you're going to need less insurance. So what you may have purchased 10, 15 years ago, it's a good time to reevaluate it, which is why we bring it up here. One other reason we bring it up. So kind of going back to the years until retirement, 10 years until retirement. So we need to think about if one of the spouses passes, you still have to make it to retirement. So you need to calculate that into how much life insurance you need. And then this is often forgotten when it comes to calculating insurance is the annual savings need to retire on time. So if your plan is to retire at 50 or at 65, and you're saving $50,000 a year between now and then, so you have 15 years worth of savings. In this case, this example, they're going to retire at 60, so they have 10 years until they're going to retire. And then the annual net spending of $150,000. So, we don't want to forget that because that's what they're spending now. So we need to kind of bring that into our calculation as well. So if you want to go to the next, kind of the next part of the slide, Britton, we'll kind of bring all this together. And so in this case, insurance need calculation, $400,000 to pay off the mortgage, $100,000 for college need. And then here's where we get to the savings until they're retired. So $500,000 in savings needs, which is 10 years until retirement. In this case, we said they're 50 and they want to retire at 60. So that's 10 years. They're already saving $50,000 a year so that they can retire on time. So we want to make sure that we calculate that in there as well. So So it's going to be 10 times 50,000, 500,000 is going to be added to what you might need for insurance. And then here's kind of the big number of it is the annual spending until you get to retirement. So you still have 10 years left of annual spending. In this case, it's 150,000. So 10 times 150,000 would be 1.5 million. So that's 2.5 million insurance need roughly. Again, there's things here you can adjust, but that's going to give you a high level of, you could plug your numbers in and get an idea of where you're at. If you bought insurance, 10 or 15 years ago, probably your mortgage balance is less than it was then. And you have more saved towards retirement. So these numbers might be able to be adjusted a little bit, but this is kind of a framework. So it's kind of a lot there. I see a few people I put in the chat, they have whole and term life insurance. Any questions here? Anything to add, Britton?
No, I just think that this is back of the napkin almost. Keep in mind that there's definitely other variables that come into play, inflation and maybe spending may even be adjusted with single spouse. I mean, at that point, things will, maybe this house is sold to there's no mortgage. So there's a lot of things that can change in the life because you get this lump sum. But I think it's the takeaway is this is a quick and dirty, like you said, Todd, way to calculate it. And at retirement, once you're retired, you're pretty much self-insured at that point, likely because you have assets built up, maybe debt's paid off, kids are off, college out of the nest. So yeah, we would look at it more granularly, but this is a great summary. But yeah, please ask any questions you have. In a couple of slides, we're going to stop. But you can put them. Go ahead.
So this is just for that 10 years in case something happens, correct? Your insurance need.
Correct.
Right. Because in theory, that's where the 50,000 of annual savings comes in. Because if you're on track already for retirement and you need to save 50,000 a year over the next 10 years to retire, then we're factoring that in. And at that point, you should be able to live off of your retirement savings. Now, there's other ways to slice it as well, but this is how we're doing it here.
So the real need is the context of everything except that savings, because that savings only kick in for retirement.
That savings is going to help you get to retirement. So a lot of people, they think I need this insurance to, between now and retirement, but you don't want to stop savings for retirement because, you might not have enough, or, you could factor it in this way, right? So if you set it aside, then you have that, right? So you already have pre-saved for it in this case, if something happens to your spouse. So you take this 500,000, set it aside, and say, okay, I'm not going to use that to live off of it because that's going to go towards my retirement.
Correct. And the 400,000, if I take it from the top down, the 400 is if something happens to me, the mortgage gets paid off. My kid can go to college.
Yep.
The 500 is for after the 10 years because my spending is within this 10 years, which is the 1.5 million. That's just a savings portion.
Yes.
So I see 3 of the 4 for the next 10 years in terms of insurance. And then the 500 is actually, let me call it a nice to have, which guards me for after retirement period to have that 500 available.
Right.
Yeah.
Okay, cool. I understand it.
Yeah.
And the annual savings needed to retire, that's a big question that only a financial plan will really answer to see, okay, what are you spending in retirement, projecting it forward. So what you're saying at that point.
But let's say you have 2 properties that has generating passive income for you.
Okay.
Then that will set that off.
Oh, yeah.
As long as whatever your personal circumstances in terms of what does it look like from the day of retirement, that's what that savings is about.
Yeah, that would be the difference.
Yeah.
Yep.
Exactly.
Okay, cool.
Yeah.
Great.
And we'll think someone asked something about long-term care. We'll get to that kind of when we pause for questions, if that's all right.
Yep.
And Britton, if you want to kind of keep going.
We're actually pausing for questions.
Oh, okay. Well, then great. Thanks. So someone asked, can you speak to long-term care insurance and if you recommend it? So I want to be careful what we recommend and not, because we can't like kind of, I'll say, legally make recommendations here without knowing your individual circumstances. But what I'll say about long-term care is we do have folks that have had it for a number of years. One of the things we're seeing is that the premiums are skyrocketing. So almost every client we have that has long-term care insurance, most of them have, kind of had it before they started working with us, and their premiums go up every 2 or 3 years, and they're substantial increases. So it's a little bit, we're a little bit hesitant when it comes to long-term care insurance, because I think what's happening is in these insurance companies that started 20 years ago, they're realizing that they're in the hole. So that essentially hasn't been profitable for them. So you need some type of long-term care plan, whether that's insurance or not, is sort of another question that's going to be real specific to your situation. I was actually just talking to someone today. They have 2 homes, and we were talking about their long-term care plan. And, they were saying, well, I have a second home. I could probably sell that. It's paid off. And that's true. That's one situation where maybe the home becomes a long-term care plan for you, or that's where your assets come from. You have to be careful though, if you're relying on your personal residence as your long-term care plan, because if you're married and one person needs to go into long-term care and the other person can still stay in the house, and can't necessarily liquidate. So what I would say with long-term care is just proceed cautiously and really look at what those premiums are. And I think the biggest thing I see is that people start down that road, they make 10, 15 years worth of premiums, and then the premiums start going up. And at that point, you're left with almost no choice because you've sunk so much into it. You hate to stop paying for it, but then it becomes, in some cases, financially not feasible to continue on that path. So again, it's a little bit of a complicated, situation with long-term care. So you really have to dig in more, but it's a really good question. I think it's on a lot of people's minds, and we look at that really closely. Anything, does that help guide you a little bit? And I don't have your name there, but feel free to come off mute or type something else in there if you like. Otherwise, we'll keep moving along.
Any other questions in addition to that one? Okay. I will move on to the next slide. So we're going to talk, just to take a pause here, PSA announcement. I've been getting these letters in the mail about data breaches from different lenders, and it's very disturbing. So we've been for many, many years, we've been recommending this, but to lock up your credit. But first, check your credit annually. Get a free credit report.com or other vendors. But the reason, if you think about how often that you use your credit to apply for loans or lines of credit, it's usually not that often. So calling each agency to lock the credit is the way to protect yourself. You all probably already know this. You work in banking, but we just want to make sure that we mention that. I think it's very relevant apropos now. All right, so I'm going to move on from here.
Sorry, that's something I've never done. Can you just explain what it means to lock down now?
Yes, absolutely. Hold on 1 second. Let me go back to that slide. Yeah, so sorry, I skimmed over this because this is very important. To first check your credit, and the way you can do that from the 3 agencies, it's from freecreditreport.com. Sometimes online banking or lenders will provide links to do this as well. Credit cards will provide links to check your credit. But to lock down the credit to prevent fraud by calling each of the agencies. So you can't do this online. You do have to physically call each one to say freeze the credit so nobody can use the credit. I mean, you can or but you have the authority because it's your credit to unfreeze it. So if a hacker comes in, they cannot use use your credit because it's locked. And so that's a way to protect you. For example, I've got clients who are retired and they're just not using that anymore. They don't have any streams of income to leverage to get a user credit. My parents, I saw them this past weekend. They're in their mid to late 70s. They've got it all locked down. And so the way to do that, you do have to call each one of those credit agencies.
So is the goal then to lock it down and only open it up when you need it?
Yeah, exactly.
Okay, I follow my credit report all the time. These days it's so easy, but
Yeah.
to lock it down is so if I don't need anything for buying a new car or a new house, I can physically lock it down on all three of those agencies.
Yep.
Okay,
Yeah.
and
Yep.
I just call the three major agencies. That's it, correct?
Correct.
Thank you.
Yeah, they'll give you a PIN, and then that's what you need to unlock it. So, but
Cool. Thank you.
you're welcome.
And I think that inconvenience of calling there's a reason for that to not make it easily to toggle on and off. Somebody can hack into your online account, probably. Like credit cards can be done. All right. But yeah, thanks for pulling me back there. Any other questions? Okay, so let's talk about Social Security for just a few minutes. There's a lot that we could have a whole session on this. We could have a whole series on Social Security in different scenarios, but I'm going to keep it high level. And first, how do I look up my statement? I go on SSA.gov. If you've never done that, go ahead and set up a secure login. They have a good method of doing that now. And then once you have a PIN, you can log in. You can see your statement, your work history, and the different estimates of what you would be entitled to in your 60s, 62 to 70. And so that's like the first thing I want to mention. But first, there's three main things that I want high level I want to talk about. First, understanding just some basic rules, spousal benefits, and timing and when to take Social Security. So the rules are you're entitled to 100% of your lifetime benefit, or if you're married and you have a spouse, 50% of their benefit, whichever is greater. And the logistics of like doing that is when you apply for the benefit, it's almost automatically given to you, like whichever one is greater, whether it's 50% of theirs or 100% of yours. Now, if you were married in the past, you have an ex-spouse, and you were married for 10 years, and you've been removed for 2 years, and you haven't remarried, then you're entitled to 50% of theirs. So when running through these scenarios, there's also a widow benefit. I'm not going to get down that rabbit hole, but there's a lot of different scenarios with Social Security, but the basic ones are it's like 100% of yours or 50% of your spouse's. Now, when to take Social Security, you have different options to do that. And the earliest you can apply is 62 to take a discounted rate of Social Security. And that's roughly 70% of what the full retirement age, or around 67 for most of you, when you're entitled to your full retirement age benefit. And so this is an example of what it looks like when you log into SSA.gov. You pull up your statement, you can see these different ages and monthly benefits. So the 67, 100%, $3,656. If you were to wait until 70, you would receive $4,621 per month. That's roughly 132% of full retirement. So you can see that it does continue to grow. And financially, it does make sense to delay or finance your way to a higher amount. We run break-even analysis of like what's the benefit of taking it early or later. And there's some online tools and calculators that can help you with that as well. But we want to look at the big picture because everyone's situation is unique. Everyone has a different health situation. So life expectancy is playing a role in this, of course, and we don't have any control over that piece. There's also tax planning that goes into this, and there's some opportunities. So let's say when you retire, you're going to likely drop into a lower tax bracket, at least in the first few years before you start taking other streams of income like Social Security or maybe even an old pension. And so it's common that we see our clients drop from 35, 37% down to like 12% tax bracket. So there's opportunities to do what's called Roth conversions when you're in those lower tax brackets. And let's say you have a lot of money built up in your 401ks over the years, like well over $1 million likely. So it can grow, and you have another liability to deal with. When you're 73, you have to take out required minimum distributions. And so there's this coordination going on. We're not just talking about Social Security now, we're talking about other tax liabilities. So when do you take Social Security? We want to look at those areas as well, because it's an opportunity to do that. If you start taking Social Security, then it's going to kick you into a higher tax bracket. So that we want to make sure that, or just you should be aware that it's not just to emotionally take it as soon as possible because you don't think it's going to be around. I feel like it's entirely your decision, but there are other variables to look at, not just on like when to take it in your personal situation, but also the tax planning that may need to be done. What else would you say here, Todd?
Just one other thing I want to add is that if one of the other reasons we see people wanting to wait till 70 is that when the first spouse passes, the remaining spouse gets the highest benefit of the two. So in this case, for example, the surviving spouse would have 4,621 for the rest of their life, as opposed to 3,656 if if it was taken at the age 67, which is full retirement. So that comes into play because all of a sudden you're going from 2 Social Security checks down to 1. So depending on how much that makes up of your total spending, I mean, it could make a difference. So that's the other thing to keep in mind, especially if there's an age difference between the two, health issues between, with one. That's something to keep in mind. And the other reason we look at too is how much has been saved up outside of IRA accounts. So if you have a brokerage account, how much is saved up there? Do you have other sources of income to draw from while you wait until 70 to take your Social Security? So that's important as well to take into consideration. So I think those are kind of the main points on Social Security.
Yeah.
So just one question. So the idea is if you don't need it, don't use it. Delay it as far as possible.
Yeah.
From a pure number standpoint, yes, that you're
Correct.
going to end up with more money over your lifetime, assuming you don't die, unexpectedly early.
Okay, but let's say I just use my 401k or equity, whatever the case, and I die at 66. At that point, even if I haven't accessed my social, my wife can still go and apply and she'll get the bigger of the two. But if she at that point of 66 don't need it, can she wait until I would have been 70, or it automatically kicks in at 66?
No, she can wait. There's a pretty good, I mean, we've worked with the Social Security Administration on this exact situation, and they'll give you a breakdown, they'll compare the two, and there is a benefit to continue to wait, because that will continue to accumulate.
Okay, so she doesn't have to take it immediately. She can wait until, and the latest age is 70, I guess.
Right. Yeah, there's no benefit to taking it after 70.
Okay.
And
cool.
if you drop your email in the chat here, we have like I don't know, it's kind of a flow chart that will take you through, like, if this, then go down this path, if no, go down this path. So it's like a 1-pager. Based on some of the questions you're asking, that it might be helpful for you to have that visual too, because it can get a little convoluted. So drop your email in there. If anybody else wants that, happy to send that over to you as well.
Yeah, thanks, Todd. forgot to mention that. So the flow charts are based around the spousal and ex-spousal benefits scenarios. All right. Again, a lot of scenarios here. We can't cover it all today, but if you have any specific questions, we'll pause in a few minutes. But let's jump into another, mid-year review to be aware of are the IRS limits of what you can save toward retirement accounts, HSA accounts. Let's start with the 401k contribution limits for 2024. Over the age of 50 is 30,500. So if you have it coming out of your paycheck every pay period, tracking to max it out, that's where it's gonna, you want to be on track to max that out for 2024. Under the age of 50, it's 23,000. For the IRA, traditional IRA and Roth IRA contribution limits, it's 8,000 for over the age of 50, and then 7,000 for under 50. I've also included here backdoor Roth IRA limits. So if you're not familiar with what that is, there are ways to get dollars into the Roth IRA, even if you're above the income threshold limit that you can't contribute directly into the Roth IRA. Now, I want to make sure that you're aware that the 8,000 is the combination of the traditional and the Roth IRA. So you can put all 8,000 into the IRA or the Roth IRA, or about 4,000 in each, but you can't go beyond that amount. In other words, 8,000 in each. So again, on the backdoor Roth IRA, just to give you, we went over this on the last session in the spring. The way you get the money into the Roth IRA is you first make contributions to a traditional IRA at your broker, and then they journal it over to the Roth IRA. Now, typically, you don't want to have a balance in the traditional IRA because of the pro rata rules of how the distributions are taxed coming out. Because the money goes into the traditional IRA, then it comes out as a distribution that's coded as a Roth conversion. And it's also important to communicate this to who's preparing your taxes, or if you're doing it, making sure you have that filed properly. Again, we can talk more about that if you want to get into the details, but the limits are the same as the Roth IRA to get money into it. And the last one on the list is an HSA contribution limit of 9,300 for family plans. So if you have a health savings account that's usually tied to a high deductible health insurance plan, and your spouse also has an individual health HSA account, the maximum you can contribute for this tax year 2024 is 9,300 between the two of them. That's over the age of 55, and then under 55 it's 8,300. Any questions, anything to add here, Todd?
One thing I'd add is that the HSA is the only vehicle here that has triple tax benefit. So it goes in pre-tax, gross tax-free, and it's taken out tax-free. So it's one thing to keep in mind. It's often overlooked that you can invest that money, and Wells Fargo through Optum offers you that option to move it over once your balance hits 2,000, and you can invest that and grow it. It just becomes another vehicle for retirement that's specific to medical expenses. So if you could do that and not touch it prior to retirement, it's going to be a nice benefit for you down the road.
Yeah, especially if you're investing it. That's one of the biggest mistakes people make, is they don't invest the HSA.
Mm-hmm.
All right. Next, we're going to talk a little bit about an opportunity cost between saving and paying off the mortgage. This is a very common scenario. We get questions from clients. Go ahead, Todd.
Yeah, this is, people want to know, should I save or pay off my mortgage? They're looking at where interest rates now on the mortgage versus either their savings accounts, CDs, or what they're earning on their investments. So the biggest thing I could say about this is that whether you save or pay off, at a minimum, you want to make sure you align it with your retirement. So if you plan to retire at 65 and your 50 years old right now, but you have 20 years left in the mortgage, you probably want to make some adjustments so it's paid off on time. What we find is that mortgage is usually the biggest obstacle to retirement because it's a fixed cost. There's no flexibility there. And it's one of your largest, for most people, one of their largest payments every month. So at a minimum, align it with, with when you plan to retire, preferably a few years even before you retire, just to give yourself some wiggle room. And, we tend to take a balanced approach with it. So, save and invest, right? Because we can't guess what's going to happen to the stock market. We can't guess what's going to happen with interest rates. So you're really at a minimum, you want to take a balanced approach to it. And I think that the key of paying this out over time, as opposed to waiting when you retire and you have $100,000 left in the mortgage and pay it off. Well, now you're have to come up with that large amount of money, which you may or may not have at the time. Two, if all your money is in a 401k or an IRA, that means you're taking a lump sum of money out at that point and maybe paying taxes on it. Maybe it's pushing at a higher bracket than necessary. And then the final thing I'll say about the mortgage is to avoid we call them refinancing pitfalls. And I'll just tell you a quick story. This is a client we've been working with for maybe 15 years now. And when they came to me, they had mentioned that this is when interest rates were obviously declining, and we might be seeing another, period of time where they start to decline again. But back then they were declining, every couple of years. And so this person was refinancing. So they refinanced, I think 3 or 4 times it was. Unfortunately, the mortgage person didn't tell them that, or didn't explain that it's a disadvantage if you refinance and go back to 30-year mortgage. So in this case, I think the first time I refinanced, he paid off, it was a 30-year mortgage. He was down to 25 years left. He said, oh, my rate went from, hypothetically, it went from 6 to 5%. So he said, great, I'm gonna refinance. Well, what he did was he ended up going back to starting over at 30 years. So what he should have done is said, okay, I'm going to refinance it, get the lower rate, but I'm going to continue paying it on a 25-year schedule, as opposed to going back to 30 years. And he did that, unfortunately, 3 or 4 times before we started working together. And he should have had only less than 20 years left. But I think he was back to like 28 or something like that. So it was really unfortunate because no one shared that with him. And that cumulative interest really added up for him. So that's just often overlooked when you refinance. So if anyone's thinking about refinancing in the next couple of years when supposedly interest rates will come down, keep that in mind. And then, Brett, I think we had a little calculation here. This is just an example to give you an idea. I'm also going to drop, let me put it in the chat right now, a calculator so you could do this calculation for your specific mortgage. So in this case, a mortgage balance of $400,000 and it's at 4%. Currently on a 30-year payment of $1,909. If you were to make an adjustment and pay it off in 15 years, so you said, hey, I'm going to retire in 15 years, what's my new payment going to look like? In this case, it's going to increase by about $1,000. So $2,958 would be your new payment. So yes, that is a big jump. But again, I think the big thing is just take these in bite-sized chunks. So if you can't do it in 15 and you need to do it in 20, make the adjustment. But you want to start early on this because it's going to catch up to you real quickly when you get closer to retirement. In this case, you can see just by making that change, you saved $154,000 in interest. And again, I would encourage you to look at the cumulative interest you're saving. I think the interest rate you're paying is important, but even more important is the cumulative amount that you save over time. And then obviously also factoring in the costs to refinance the mortgage as well. Sometimes those can be, $2,000, $3,000, $4,000 depending on the size of the mortgage.
Okay, we've covered quite a bit over the past few slides. We're going to pause for questions there. Just to kind of recap, whenever credit, Social Security, savings throughout the year to retirement accounts, and Todd just went over loans, in other words, mortgages, when to pay it off. And we suggest to get it paid off by retirement.
Yeah, any questions? Feel free to come off mute or drop them in here. We've gone over quite a bit, but again, we want to make sure that, we're covering the questions you have. I think had some great questions so far and want to make it as helpful for you as possible. Anyone?
Todd, I have a question.
Yes.
So on the mortgage, let's say you get to the break-even point where you can get rental income for paying off your mortgage.
Yeah.
Let's say I'm 55 now, and that will go until the next 15 years to get my mortgage paid off. But I have sufficient with, let's say, a little buffer to make up for whatever on maintenance. So I know I put someone in the house, they can, in theory, pay off with the rental income. I'm covered. At that point, would you say it's a good idea to invest in another property instead of, because now I have someone else paying off? I do have a risk. Let's say I want to retire at 65, but the property is only paid off by 70. So those 5 years are a risk for me, but I'll get better money out of, better use out of my money by buying another property and the equity gain on that property than remaining with status quo.
Yeah, so it sounds like you own rental property, right? This is not obviously not your personal residence, or you're one talking about rental property, correct?
I'm talking about I don't have one, but my context is I have a primary property, and the point of sitting here trying to pay it off till the last dollar doesn't make sense to me. I can rather use that for a break even with a rental income and buy another property. Even if it's a 30-year loan, the equity that I'm going to get on the second property is more than the interest payment that I'm going to pay over that time. And in the meantime, someone else is going to pay off the primary property with the rental income.
Mm-hmm. Yeah, I mean, that's a good question. Yeah, I could speak from personal experience. I own residential rental properties. And so this is a kind of an exercise I've done for myself specifically. And, I think you bring up some good points. I think the key is you have to buy the rental property correctly. So, my approach is a balanced approach. So yeah, some of my retirement will come from rental income. Some will come from 401k and just regular investments in a brokerage account. So you're asking a really, really good question. It's tough to give you a yes or no on it because there's so many factors involved in it. For me personally, I've chosen to kind of pay down my properties, and that's maybe more of a conservative approach. But I think, continuing to hold them and continue to maybe have a mortgage, there's some validity in that too. One of the things my CPA told me early on when I started purchasing rental properties, they said, you really don't make money on rental properties until they're paid off. And I found that to be 100% true, because usually there's not that much cash flow in it, depending on obviously how much you put down. So, yeah, I mean, we could talk more offline about, your specific situation.
Sure.
If you're going to buy property. So I think there's a lot of different ways to slice it, a lot of different strong opinions about it. There's often not like one right or wrong. It just needs to be part of a bigger picture, I think. And I think that's really where the kind of the answer lies, and what's that bigger picture look like?
Yeah, not having all your eggs in one basket concept. Correct.
Yep. Yep.
Thank you.
Yeah, you're welcome. Who else? So Angie mentioned, okay, so she brought up about the Optum HSA. Yeah, there's and we could probably send you some screenshots of it, or even hop on a call with you and walk you through it if you want to drop your email in there. But once, just to kind of revisit it, if you've logged into your Optum account, there should be a button. I apologize, I can't visualize it right off the top of my head. I think it actually says invest on the top, or it's in one of the drop downs. And so once you've accumulated $2,000 in there in your HSA, they will allow you to move that money into the investment arm of the HSA account. And then once it's in there, you have some options to select different investments. So, yeah, it's pretty straightforward. Again, it's just, and again, we're happy to do a quick screen share with you and take you right to where you need to go to do that. But it is, most people don't know that. So you're not alone. I'll admit, my wife works at Wells Fargo. It was a number of years before I saw that they had that benefit. So so hopefully that helps. And again, happy to walk you through it because
And the question, Todd, it was how do I invest the money on Option Bank? Was
it
that
was, I didn't know, realize you can invest it. So I
Oh,
think the
got it.
question was like, how do you even find that option?
Correct. Yeah, it's funny. We
So
went over that in the last session in the spring, so we actually have screenshots. But yeah, so yeah, we know how to help you if you want to talk further. Okay, I'm going to get going. You know, a little bit more to go over. And the next one, we're going to talk about risk. I'll hand it back over to Todd.
yeah, it looks like we're coming up on, we got about 13 minutes left, so we might go through this a little bit quicker. I want to make sure we save room for, questions. These are really good questions. I think as people are approaching retirement, they're always, the big question is, are my investments correct? It may not be exactly how they say it, but, is my money making the most for me? Is it, am I, so, is it properly allocated? Is it too aggressive, too conservative? So one of the things that or three of the things that we kind of go through is, I call it match, diversify. So one, you want to match your risk tolerance. And I'm sure many of you, if you have 401ks or you're working with an advisor, you've gone through some type of risk tolerance survey. So that's pretty straightforward. What are you comfortable sleeping at? What won't keep you up at night? You don't want to take on too much risk. And then the next one, which is not really talked about a lot, is match your risk capacity. So that really looks at your personal situation, the investments you have, how, if you're on track or off track for retirement. One of the things we believe is that there's no reason to take excess risk to get to retirement if you don't need to. So risk capacity is really how much you need to take to meet your longer term goals. And surprisingly, a lot of times it's a lot less risk than maybe you need to take. What we see is that if you enter retirement or even approaching retirement 3 to 5 years out, oftentimes if you're invested more aggressively, say 80, 90, 100% in stocks, you actually create a greater risk for yourself than if you, I'm saying, again, I have to look at your personal situation. Maybe a disclaimer, I can't give investment advice on this call. So let me just step back a minute. But oftentimes we'll see someone that maybe has 80, 100% invested in stocks. If they pull back to 60%, their overall plan is more successful. And when I say overall plan, it's from, the day they retire till, the age 90 or so, right? So we're not looking at just 1 or 2 years. We're saying you want to look out farther and see, okay, how much risk should you be taking? And my belief is let's minimize the risk as much as possible because there's so much uncertainty out there. We don't want to put your retirement in the middle of all that uncertainty. The last thing I'll mention is just diversify. We oftentimes see, especially at Wells Fargo, the match at the end of the year, they'll put in all Wells Fargo stock. If you've been working there for a number of years, it's not uncommon. We see 10 or 20% of a person's 401k in Wells Fargo stock. So you have enough risk in Wells Fargo just because your paycheck comes from there, right? So you never know what's gonna happen. So you definitely want to diversify your holdings. You want to be careful about holding too much Wells Fargo stock. And whether it's Wells Fargo or any other bank or any other company, I'd say the same thing. I'd also look, if you're not familiar with the age-based funds at Wells Fargo, I would take a look at them. Oftentimes it kind of takes a burden off you in terms of trying to pick 5 or 10 funds and reallocate those and come up with a specific investment. So the age-based become automatically more conservative the closer you get to retirement. So for some people, that's a perfect fit. For some people, they want to be a little more hands-on and, pick the individual funds themselves.
All right.
So I'm going to keep moving along here, Britton, because we're getting close to the top of the hour. We will save time at the end for questions.
Okay.
So next thing I want to talk about is, again, I think that the burning question is, if I retired today, I would have enough money. Would I be able to have enough income, whether that's Social Security or coming off of your savings account? So one of the things I'm going to talk about here is the 4% rule. And if you've heard of the 4% rule, just kind of drop the number 4 in the chat, just so I have an idea of kind of familiarity with it. And this is just a rule of thumb. Again, one of the things we're trying to do is giving you some overarching things to look at. We talked about some insurance rules of thumb. We'll look at the 4% rule and how you could maybe use that to give you an idea of where you're at. There's so much more that goes into determining if you have enough. But I want you to walk away here with at least an idea of your situation. So step 1 is calculate your retirement savings. So that would mean look at all of the assets you have, add those up. It might be your 401k, investment accounts, IRA accounts. Home is going to fall in that category, but as you'll notice, we're going to back that out. And we'll subtract out any liabilities, so mortgage, any other debts you have, and then subtract your home value. A lot of times people put home value into their retirement savings calculation. I don't necessarily suggest it because you do need a place to live still while you're in retirement. We talked about long-term care insurance before. Oftentimes it's used in some capacity for long-term care, so we'd like to kind of carve that out. So that's the first step, is to come up with what your retirement savings are, or what the retirement savings is, and then apply the 4% rule. What the 4% rule simply states, and I'll go through some examples for you here as well, but it just assumes you have a kind of a balanced portfolio, so 50% in stocks, 50% in bonds, and then you take out 4% on that first year. So you retire, say you're retiring this year, and you withdraw 4% from that your first year. And then depending on what happens with inflation, if you have inflation, say of 5%, then you're going to increase that withdrawal by that percentage. So your 4% will go up slightly, say to 4.1 or 4.2%. And then in that second year, you'll take out a little bit more. And then this aims for the portfolio to last for 30 years, roughly. Again, this is, rough rules of thumb. So, you can't just set it and forget it here. There's a lot a lot more that goes into it. And then some examples, just to give you an idea, if you could kind of map your savings onto this. If you have 3 million in savings and you're taking out 4%, that would be 120,000. In income, 2 million would be 80,000, and 1 million would be 40,000. Yes, and then the next thing is make sure you add some Social Security onto that. Don't forget to deduct taxes, and then simply ask yourself, if I was retiring today based on these numbers, could I live off of this amount? And you may or may not be living off of it now, but oftentimes the incentive to retire in a certain period of time, you make some adjustments. So that's kind of a breakdown of the 4% rule. And again, you can map it on to your, to your situation. So I'm going to kind of fast forward here a little bit. We have a couple minutes left. So I apologize, I'm going to go through this a little bit quicker, but we get this a lot. Are you holding enough in taxes? And the top image here is top snapshot is just a sample Wells Fargo pay stub, and then the bottom is the 1040 of your tax return. So we like to bring this up now because oftentimes people will look at their taxes at tax time, so in April, and say, oh no, I owe so much in taxes. It was a big surprise. And there are ways to kind of do a back of the napkin to calculate it yourself. So we're just going to assume that this is your pay stub from June 30th, just for simplicity's sake. So in this case, this person withheld $25,000 in federal taxes through June 30th. And then if you pull up your 2023 tax return, go to line 24, this just shows you how much you paid overall in taxes in 2023. So you can use that as kind of a benchmark. So this is everything you paid to the government. This is not what you owed, not what was deducted from your pay stub. This actually shows you what you owed the government total. So if you're on track to take 25,000 out halfway through the year, that means you're going to be about 10,000 short at the end of the year. So you have enough time to make adjustments. You can go on to Wells Fargo slipping my mind, I think it's Workday, and you can make adjustments. You can do an extra withholding, for every pay period, flat dollar amount to make up the difference. Again, this assumes your pay is about the same as the previous year. Obviously, if you had a big raise or a big bonus, you want to factor that in too. But this is just where you could look to kind of get an idea of it. So I'm going to kind of keep moving along here. We can, again, answer any questions on this towards the end.
Yeah, I'll jump into estate planning, run through these bullet points just to be aware of. Even if you don't have an estate plan, you can still take action and do some of these things. So first thing is a review of 401k, your IRA, and make sure you have beneficiaries set up. Most of you probably have like the primary set up. If you don't have contingents, you want to make sure you have a contingent beneficiary on those accounts. And a lot of times it's this primary spouse and the children are contingent beneficiaries. Life insurance policies got to do the same thing. And so by doing those three things, you're avoiding probate. So you're not going to have to, it's not going to go through that process. It goes right to those individuals and avoids the court costs and court process. The last couple of pieces here is like, how old were your children when your will was last updated? So if you do have a will, ask yourself that question. And the awareness here we're bringing up is like, well, how old were the kids then? How old are the kids now? And how much money do you have? So a lot of times since the estate plans are created, we see our clients, net worth has gone up, and so there might be a need for a trust, and that brings a vehicle to provide specific ages that they would receive that money. And so again, it's a personal preference, but a trust is going to help you distribute those assets, and again, avoid that probate process for the most part. And like that, for example, my kids will get the money at the age of 30, and so I've got some clients who want to do a different age, like 25 and 30 and 35, different increment amounts. You can structure the trust how you wish, and so that's going to allow you to do that. Go a little fast here, but I think the main takeaways are you can make these changes and protect your estate by just updating the beneficiaries on your accounts and life insurance policies. All right, and so to kind of pull it full circle, there's a lot of moving parts. These are the financial quadrants, as we call them. You've got cash flow management, investment positioning, tax planning, and estate preservation. Really any decision that impacts you financially fits somewhere in one of these areas. This is kind of the core of our financial planning process. We've touched on just about all of them in different capacities, but as you can tell, the coordination with the needs, they aren't in their own silo. They have the Social Security, there's tax planning with that. So you're going to need to identify and also manage all that. And you have different professionals in your arena. Are they communicating? And so you want to, whether you're doing it yourself or you have an advisor, financial planner, you want to make sure that there is some communication coordination within each. All right, so that brings us to the end of our session. I think we are right on time, actually, 1 o'clock.
Yeah, we did have one question. I think Joe brought up a good point. He talked a little about the age-based funds, and I think he's tracking them against the S&P, and he said they underperformed. So I think it's a really good point. You have to look under the hood to see what's happening in those age-based funds. So what are they invested in? They're not in the S&P, so they're in something else. So you really want to understand why they're either underperforming or outperforming in certain periods of time. So I think that's a really good point that he brings up. So you want to look closely at that. The other thing he asked was, when you do use these funds, do you target, I think what he's saying is, do you target being conservative on the day you retire, or is it over your lifespan, expected lifespan? So what we tend to see, how we approach it with our clients is, you want to get more and more conservative as you approach retirement, and that's what those do. They get more conservative as you approach retirement. They tend to stay, and each one is a little different. They tend to stay a little bit more conservative during your retirement. They don't necessarily continue to get more conservative the closer you get to when you pass. there's at some point that they kind of stop getting more conservative. So, you know, you have say when you get to retirement, it's 60% stocks, 40% bonds, right? So you can sustain that throughout your retirement, you know, in most cases, because you have two buckets. You have a bucket for longer term growth, which should be the 60%, and then you have a bucket 40% that's should be more conservative, bonds, cash, some type of, you know, fixed income, and that's what you use to draw on in the near term. When I say near term, you know, next 3 to 5 years, maybe even upwards to 7. You want to make sure you make it through any market corrections or any economic turmoils. So you want to make sure you have a large enough bucket of something conservative so that you can pull that money out. But yeah, you bring a good point. I think there's more nuances the closer, you know, when you get in your 80s. Again, you could continue to take less risk. I don't think the age-based funds do, you know, a great job at that point, or even when you get into retirement, because you have to think about withdrawing money and is that the most optimal vehicle to do it. So that's a really good point you bring up, Joe. Hopefully that you know, that answered it. You can all come off mute if you want, if you have questions and want to chat more about that or anything else.
And all the age-based funds, they're not all created equal. So looking under the hood, like Todd said, is not something that most people have the expertise to do. So that's kind of, you know, taking on that responsibility about creating your own portfolio and multiple funds. You know, the average person doesn't know how to do that properly and manage it. So that's what these funds are built to replace. But it is only looking at one thing. That's that time frame. There are other variables that we want to look at in a full plan.
Yeah, and we did go through the last couple of slides pretty quickly, the taxes and then the 4% rule. If anybody wants to revisit that, we just want to make sure we honored your time and finished here at 1. We can circle back there as well.
Yeah, we went through this pretty quick.
Yeah, and let me see. And we'll stick around here for, you know, a few more minutes if you have questions. I think we covered everything. Yeah, definitely with Angie with the HSA, you had asked about that. Shoot us a email. We'll show you how to set that up and show you where to go on Optum to do that.
I have a question about the financial calendar.
Yes. Oh, yeah. Thank you. Let me drop that
when
in
or
there.
how will we receive that?
Yeah, thank you. I usually drop it in. We
Put a link in the chat.
I did mean to drop it in here, so I appreciate that. Just dropped it in there now, and you could just go there, go to that link, and it'll just download from there. You just click on it. So thank you.
Anybody else would like the Social Security flow charts? Please put your email in there because we don't have them linked.
Yep, I think one person wanted it so far, so we'll shoot it to them. Oh yeah, someone else asked about the back door. Sorry, I think we did miss that question. So is this an option for people over the annual IRA income levels? Currently maxed 401k limit, most in Roth, but don't qualify for regular Roth because of income level.
Yep.
It is an option for people over the annual IRA income limit. That's that's the most common way we use it, the backdoor Roth. The kind of the hitch to this is if you have money in your IRA already, your traditional IRA, there are some tax consequences to making the Roth conversion. So typically we will advise to do the Roth conversion when you have all your money, say, in your 401k, but not in your IRA, because it creates a little bit of a tax consequence there that in turn may not make the Roth conversion as beneficial as it can be. So again, we're happy to talk to you offline on that. It is a little bit more of a, I don't want to say complex. I mean, once you do it a couple of times, you figure it out. But the first time it's not always that straightforward unless someone's really kind of holding your hand through it. But that's a good question. Let me see if anyone else put anything.
And if you do consider doing the Roth conversion, you want to do it well before early December, because within the same tax year makes it for cleaner accounting and filing purposes. Because once you get into late December, the brokerages get really busy with things like that.
Mhm. So, okay, I think we're going to wrap it up if we don't have any other calls. So again, contacts in there if you have any other questions about your individual situation. We're happy to chat with you more. And we'll.
Thanks, everybody.
Yep.
Thanks for stopping
Take
by.
care. Weekend.